This is Talking Capital Markets, where ideas drive the markets. We move past the headlines and into the heart of the deal, breaking down IPOs, M&A, governance, and the strategies driving real growth in today's capital landscape. No noise, no hype, just conviction, execution, capital in motion. If you're building companies, raising capital, advising boards, or deploying investment, you're not just listening, you're in the room. And now, here are your hosts, Mike Blankenship and Brian Jue.
Thank you for joining Talking Capital Markets with Mike and Brian. I'm Brian Jue.
And I'm Mike Blankenship.
Mike, we've talked a lot about going public, and we've talked a lot about it. Let's talk today about how going public can help the eventual exit process, even if someone's looking to potentially just for that exit transaction through M. And we call that the dual track. And so if we want to elaborate a little bit more about that, let's chat about that today.
Yeah, love to talk about dual track. It's definitely a topic that's pretty much every month important piece because, you know, bankers and boards and everyone likes optionalities, especially company management. And so if you're looking to do a liquidity event, using the M&A process alongside the IPO process can help because it can create some of that positive leverage that you want. So it gives them sort of shortcuts into getting the either the M&A deal or the IPO deal and seeing where the value is. Because once you do the M&A, you get a lot of bidders. If you do an auction process, you understand sort of how the value is coming together. And then look, doing the IPO, the bankers go out and do indication of interest, you know, testing the waters and get a sense of the valuation there. So you really see where your company trades and whether it makes sense to do one or the other. And on the leverage part, the M&A side of it, you do the M&A, you do the auction process, but hey, you have this S1 that you've confidentially filed with the SEC. And if you want ultimate leverage, you then file it publicly once you kind of clear comments. So then the buyers on the potential M&A side say, well, this guy was going to do an IPO. We better hurry with our M&A process and get the diligence done. So it's a lot of the trying to get that done right and seeing where you can maximize the value and the option on that. But what's the right fit? What is the right governance and everything controls that you'll have to have if you're public? What's the right way if you're going to transition, if you're going to stay and be on the M&A side and be bought out by somebody? So that's how I see it on the dual track. And why we call it dual track is just two separate areas going at the same time. So it's a lot ongoing.
I think it makes a lot of sense. And let me try to give a real world example, and then you can help out if I miss something here, right? But let's say a company, let's say they're working on something that they've got an MVP, they're at market, they've got revenue, and it's something that they think that they're trying to position for an acquisition with, you know, one of the big players. They see maybe a Meta or a Google or an Amazon coming in and making that strategic acquisition and buying the company. You have a lot of founders that think that way. What they often miss, though, is unless what they're working on is that special, and these days it's hard to have something that's that special, you don't know if one of those big players is already taking your idea and saying, hey, let us just put it together ourselves. Why make that acquisition? Let's just build it and do it ourselves, right? So if you're pursuing this dual track, though, and you're thinking that, hey, it's strategic acquisition and that's the only way to go, one of the flaws there too is you also have sometimes when that does happen, a larger company will come in and say, all right, here's some cash, but where you're really going to make the money is on the royalty, et cetera, but then they just bury it, right? But if you're going down the dual track, you're out there, and let's say you take that public filing of the S1 process. So you prepare like you're going public, even though you ultimately, hey, if someone comes up with a big enough offer, you're selling and you're exiting, but you prepare like you're going public. You do everything right, which makes you a cleaner, better sale anyways in the M&A process. But now once you file that public S1, you're on the radar of all these other players, all these big companies, and they're going to see that, hey, these guys are filing to go public. If we want it, we need to buy it now. And now you're going to get a higher valuation that you would have received just being purely private. Maybe you're not getting that full private to public arbitrage, but you're getting more. And so that from that concept alone, I see the dual track making a lot of sense. Does that make sense to you?
Oh, 100%. I mean, it really is about what drives value. And so all the stakeholders, which is the best. And I do think as long as it's integrated, you have the right financials, everything there. And then management tells that story that can be both good for investors on an IPO or good for a buyer, and there's no uncertainty, no confusion. I do think you can do a pretty good job with getting that dual track done and be successful and get the most value out of it.
And if they do move forward with that process of the IPO, for a lot of the founders that say, "Well, I don't want anything to do with being publicly traded." Well, it doesn't mean that they have to be in charge of that public process. They can certainly, be still involved in the company. They still have shares, but now they've actually had the opportunity to get multiple bites of the apple. They do get something out of the IPO, something at that exit. But now, as that company continues its ascension, they have the opportunity to take more off the table at different points in time.
Yeah, and that does create some good incentives, some good leverage for them as well. So I think being able to take some of the chips off the table, I do think it's an important piece as well.
With all that in mind, with the, pursuing that dual track, how do you feel about when companies do want to potentially use the IPO process to expand via acquisition? And when they're looking at that as a potential too, where do you see the potential acquisitions lining up? You see it, if it is the dual track mindset, do you see that as better to position post IPO, or do you think it's still an advantage to position acquisitions pre IPO?
Great question. I think it's post IPO every time, just because your integration, everything's done. You already have public company ready financials, audit ready financials. And to be able to incorporate those companies or integrate them into your business itself or have a new line of business, however you're going to use it. I always think it's better kind of post IPO, just a lot cleaner and less distractions. I think a problem is companies can get the M&A itch and really want a lot of stuff, but at the same time, forget that they're going down this other route of an IPO. And so that gets kind of set aside. So I think you really need to focus on one or the other or both and make sure you have the right team doing so. So that's that's how I view it. I think my experience with working with a lot of companies that have done just that, I think post IPO is always sort of an easier route for them to go. And it helps from internal controls, helps from, even from a legal perspective, everything that they have that they're getting in place to be public is better.
And that makes total sense. And I think it's key to note here as well is that, part of what we're doing here on this podcast is, we're sharing our experience, our views, things we've seen in the real world. And it's not always the same, right? There's, depending on what you're trying to do, what your goals are, often dictate what the strategy is. And we've seen so much, so often, in the capital market space. And this is all the way from venture to PE to investment banking, everything in that sphere is often you have advisors preaching the same thing over and over again, saying, "Oh no, you have to do it this way," or "No, you should do it. You should only acquire companies here and not here." And they try to make it completely formulaic. Well, yes, there are certain things that can be formulaic, but depending on what you do, everything it's a unique situation, and strategic planning and how you look at things, and whether you're doing a consolidation, whether you're doing a dual track, these things all matter when you're looking to raise, when you're looking to potentially IPO. Everything matters.
100% agree. I mean, it really, to your point, it's a facts and circumstance thing. It's not everyone is cookie cutter, because if everyone was cookie cutter to do it, then everyone would be doing these deals all the time. The market would be moving. As we all know, things rush into it and then the things slow down. So you have to look at your own singular circumstances and play the facts out. What you and I are doing here, Brian, is giving people our anecdotes and how we see it or our views on it. But definitely think each founder, each company, each investor needs to look at it differently and take those circumstances into their mind about how to best play it out. So yeah, totally agree with you.
Mike, thank you so much. This is what we're trying to do, talking capital markets with Mike and Brian. We're trying to educate, trying to help. And we thank you for joining us and look forward to seeing you again soon.